Over the past 5 years, I've been accumulating slowly and building a larger and larger growth-oriented portfolio, which you can see in my X profile, all broken out in terms of the positions, comprised predominantly of Tesla, of SoFi as well. Bitcoin and crypto is in there as well. But in 2024, one of my goals was to create a dividend portfolio. And in this video, I'm going to be sharing why I did that, how I did it, and all 24 positions that I bought last week to comprise my new dividend portfolio. Okay, so first and foremost, let's start off with the elephant in the room. I don't usually talk about this because my channel is generally geared towards growth investing, because I've never had a dividend portfolio before. I've never felt the desire to have one, frankly. But throughout 2023, I felt that I didn't want to keep aggressively adding to my growth portfolio, as you know, volatility is a very real thing that we've seen over the past 5 years. I've been building up my growth portfolio over that time, and it was almost exclusively my nest egg. I'm fine to watch those positions go up and down, 50%, 100%. But as the numbers in that portfolio got larger and larger, and quite frankly a little bit scary, I didn't want to have that as the only source of the nest egg. Essentially, I wanted to diversify into other forms. And earlier this year, I began lowering the rate of deposits I was making to that growth account and putting the majority of that cash aside to a high yielding 5% savings account. And that cash that was sitting in that savings account kept growing and growing and growing. And as we head into 2024, the thought process for me was whether I wanted to invest in real estate or whether I wanted to be staying in equities. And really, Toronto real estate is not great. I'm not super excited about that. Either I'm going to buy something and live in it, in which case I wouldn't cash flow, or I'll buy something and rent it out, in which case it doesn't make sense from a numbers perspective. The prices are just so inflated in Toronto. And so I figured the equities market, especially going into 2024, would be more favorable for me as a starting point. And dividends is an option that I've really admired for the cash flow aspect, but I really wanted to build up that growth portfolio as early as possible so as to maximize the time that can accumulate. And so I figured this was the perfect time when that growth portfolio was already pretty much fully built out, and I had a good chunk of capital in a savings account. We know that rates are, going to be cut eventually this year. And so I decided to start that dividend portfolio. So that's why I started it now. And that's sort of where I'm thinking about it strategically in the context of building multiple streams of wealth. Obviously, in a couple of years, the last avenue remaining for me is going to be real estate. And so I'm going to have to be exploring that, whether it's in Toronto or whether it's somewhere else. I don't know. My career might also take me in different locations. So that's also another reason that was a deterrent for me to buy real estate here, because I might get a job in the States and I might move there or wherever, and then I would be stuck with a property that I can't manage on a regular basis. Anyways, in terms of the criteria for the dividend portfolio, I wanted to have 15 to 20 names. Ideally, I wanted to have something that was semi-manageable and not super overly diversified. Of course, some of these names could be ETFs, and that's fine. I ended up with 24 names. I'm not super upset about that. I'm totally fine with that amount. I actually did a 2-hour session with Matt Money and Steven Fiorillo, both of which are pros at dividend investing, where I put forward different names as candidates for my own research, and then we chatted through the pros and cons, and we whittled down that list of 24 names. That video is actually available for members only on my channel, so if you are a member of the channel, you can go through the entire thought process, start to finish, in an unedited, raw, 2-hour video where we pick those 24 names. The other criteria was, I wanted to have some diversification across verticals. So, I have some financials, I have some, consumers, some cyclical, some technology, but I still wanted to have some growth in the portfolio. I didn't want to have just, a stagnant company that I just bought for dividend. And so it's sort of a mix between some low yielding high growth companies and some high yielding low growth companies. And it averages out to 4.5% dividend yield exactly over the 24 names. Let's now walk through some of the names in the portfolio in no particular order. The first name is, of course, Apple. Apple has a very low dividend yield. I think the lowest yield on this entire list at 0.52%. It's more so around the fact that I wanted exposure to big tech and having some of that growth, especially with the buybacks. I also bought Microsoft 0.78 dividend yield. I mean, these are the two FANG stocks, let's say, that do pay a dividend. Amazon doesn't, Google doesn't. And so I bought Apple and Microsoft. The third position on the list is American Express. It was in between American Express and MasterCard and Visa, and at the end I chose Amex. Amex has a 1.3% dividend yield. The fourth position is Realty Income, ticker symbol O. This is a REIT, it pays out monthly. It was between this one and Simon Property Group, and I went with Realty Income. The fourth one is VICI, V-I-C-I, or Vici, however you pronounce it, at 5.33% dividend yield. Similar idea here. The fifth position is Coca-Cola. It was between this and Pepsi. We had a conversation around this. A point for Pepsi was that they owned Celsius, and I like the growth. But at the end of the day, Coca-Cola seemed better from a numbers perspective. If you watch that full 2-hour video, you'll know what I'm talking about. The dividend yield was about 3.08%. The next position on the list is Exxon. It was between this and Chevron. I wanted exposure to that sector. The next one is Morgan Stanley. The next one is JEPQ. I really like JEPQ actually because it gives you wide exposure and it has a really high dividend yield at 9.91%. So I'm a big fan of JEPQ. It was really between JEPI and JEPQ, and I was more bullish on JEPQ just because of what it holds. The next one is PDI, the PIMCO fund. This was a suggestion from Steven. I liked it because it had a really high dividend yield, the highest on the list here at 14.21%. And also Steve made a really good case around why this would be going up in 2024. The next position here is Citigroup, which I purchased. It was between Citi and JP Morgan, and quite frankly, I really like JP Morgan. Obviously, they're the leader in that space, but I just think Citi has a higher room to rebound. They're trading very cheap right now, and so I think that there's a opportunity for growth there just from a rebound perspective. So we'll see how that goes. Also, the dividend was higher at 4.09%. The next position here, Verizon, 7.02% dividend yield on Verizon. I know Chris Patel has made a bull case on Verizon and the whole thesis there around 5G. We had him on the Stock Tank recently, talked about it, and so I wanted to have Verizon in the list. The next one on the list here is RTX, Raytheon, 2.77% dividend yield on this one. And like I said, again, just gives me exposure across all verticals. Next one on the list here is J&J, Johnson & Johnson, 2.95% dividend yield. I don't think you can go wrong with this one. I was also looking at a lot of companies that have a rich history of increasing their dividend over decades. And so a lot of these names are going to come as no surprise to any dividend investor out there. Next one on the list here is 3M at 5.51% dividend yield. After that, we have AbbVie at 3.79% dividend yield, followed by Target at 3.10% dividend yield. It was between Target and Walmart, and at the end of the day, I went with Target. Next one on the list here is Enbridge at 7.35% dividend yield, followed by McDonald's at 2.27% dividend yield. There was a conversation around, whether I wanted Starbucks or McDonald's, and at the end of the day, I just went with McDonald's because I just felt like it was a better bet. The next one on the list here is Home Depot. I really like Home Depot. It was between Home Depot and Lowe's, and I just went with Home Depot at the end of the day. Next one on the list is Broadcom, ticker symbol AVGO, followed by Starwood, STWD at 9.19% yield, followed by Bristol Myers, BMY at 4.78% yield, and the last position on the list is NextEra Energy at 3.08% yield. Now, one thing I will note is that there is an absolutely equal weighting on all of these positions. I basically took the total amount that I'd invested and I just divided it by 24 and I put that exact amount in all of these positions. And over this year, I'm going to be ramping this portfolio quite heavily to get it as fast as possible to be as big as the growth portfolio, which is going to take a little while. It's not going to take 4 or 5 years again. It might take a year, maybe 2 years, and it's going to be fairly automated. I'm just going to be allocating to the pies equally. I'm not going to be playing favorites with a lot of these names because I don't want to mess around with that dividend yield too much by over allocating to one name versus the other. So right now, that's my dividend portfolio. It's 24 names. Let me know what you think in the comments. I'd be really interested to hear your thoughts. I'm not sure how this video will do, especially because my audience is mostly, SoFi related, and obviously we didn't talk about SoFi once in this video, but one thought that's been going through my mind is maybe make this a monthly series where once a month we check check in on the dividend portfolio and see how it's doing. I'm still allocating money into my growth portfolio. I'm still putting money into Tesla, into SoFi, just not at a crazy rate like I was doing 2 years ago. I'm more so doing it at a more passive rate when I see opportunities in the market, and I'm still DCAing in regularly. But a lot of my attention is going to this dividend portfolio for the time being, because I just want to stand it up as another pillar of that wealth creation, and eventually get to a place where the dividend portfolio and the growth portfolio are contending in terms of their size, and then I can focus on other avenues such as real estate. For right now, this is the Fundamentals Investing Podcast. Thank you so much for listening.